You can spend decades meticulously building your net worth, only to watch a single medical emergency or unexpected tragedy wipe out every dollar. That is why insurance exists. It is a strict financial mechanism to transfer your personal liability into a massive collective pool. Most modern policies wrap basic risk transfer inside complex hybrid structures. This forces you to weigh immediate monthly cash flow against long-term medical autonomy and tax-sheltered wealth generation. This chart shows the core metric for evaluating any policy, the trade-off between the upfront capital required and the back-end freedom you get in return. Down here in the bottom left, you have the simplest approach. Basic risk protection demands very little of your capital, but it offers zero wealth generation and strictly limits your medical choices. Up in the top right is the absolute maximum tier of coverage. Securing ultimate medical freedom and tax-free wealth accumulation requires immense capital and active, ongoing management. There is no universally perfect setup. Financial ruin happens in two ways. Either you drain your investment capital to overinsure, or you underinsure and face bankruptcy when a crisis actually hits. This infographic illustrates the 10 essential health benefits mandated by the Affordable Care Act. Whether you buy the cheapest or the most expensive marketplace plan, you are legally guaranteed coverage for these baseline services, like emergency care and prescription drugs. If your priority is preserving your monthly cash flow, health maintenance organizations, or HMOs, offer low premiums and little to no deductibles. The cost of that low premium is severe gatekeeping. You must route every specialist visit through a primary care physician for a referral, and if you go out of network, you pay entirely out of pocket. Preferred Provider Organizations, or PPOs, are built to remove that friction. You can see a specialist instantly, without a referral. To buy that freedom, you surrender higher monthly premiums and take on substantial deductibles before the insurance even kicks in. Point-of-service plans attempt to hybridize these two structures, combining the primary care requirements of an HMO with the nationwide network access of a PPO. But for frequent travelers, POS plans carry a hidden trap. While out-of-network care is technically covered, it triggers aggressively high penalty deductibles. Overpaying for a PPO you never use bleeds your wealth, but choosing an HMO simply because it is cheap can trap you in a limited local network, exactly when you need specialized care the most. When we look at life insurance, the choice splits between straightforward income replacement and complex estate planning. Term life is the cheapest, highest-value method to secure a massive death benefit for a fixed period, usually 10 to 30 years. The psychological hurdle is that if you outlive the term, the policy vanishes. It builds no residual cash value, meaning your direct financial return on those paid premiums is exactly zero. This matrix shows universal life, the permanent alternative designed to solve that zero ROI problem. It attaches a growing cash value account directly to your death benefit. Indexed Universal Life attempts to grow your capital by tying the cash value to stock market indices like the S&P 500, but the insurer strictly caps your upside gains in a good market.
Variable Universal Life offers the most control. You manage direct stock and bond subaccounts, giving you the highest potential yields, but also hitting you with the highest administrative costs. The failure state here is catastrophic. Because premium payments and cash values fluctuate, missing a single payment during a market downturn can cause the entire policy to lapse, instantly wiping out years of accumulated wealth. Term buys cheap, reliable protection. Universal buys a highly complex, tax-advantaged investment vehicle that demands rigorous, unforgiving maintenance. The primary marketing pitch for permanent life insurance is the ability to withdraw or borrow against your cash value tax-free. This table outlines the specific tax implications for these accounts. Notice the top row. You can only withdraw an amount equal to your policy basis, the total premiums you have paid into the system, without triggering taxes. The moment your withdrawal exceeds what you paid in and taps into your actual investment gains, you owe taxes on that money. The rules get even stricter if you overfund the policy, and the IRS reclassifies it as a modified endowment contract. If a policy becomes an MEC, taking a loan against the cash value that isn't fully repaid subjects you to complex taxes on the unpaid portion. Tax-free growth is a powerful tool, but violating the strict withdrawal protocols will instantly turn your financial safety net into an unexpected tax liability.
Insurance is not a single isolated choice. It requires building an interlocking stack of coverage based on your primary financial constraints. This flowchart starts by identifying your main objective: preserving immediate cash flow, maximizing your medical freedom, or sheltering high net worth estate assets. The budget-conscious baseline is for young families or early career professionals whose priority is catastrophic protection without draining their monthly take-home pay. This group needs the baseline stack: term life paired with an HMO. You sacrifice immediate medical choice and asset growth to guarantee your family avoids bankruptcy from standard crises. Next is the mid-career flexibility seeker. These are individuals with healthy capital who value their time and refuse to deal with gatekeeping referrals. They require the flexibility stack: term life paired with a PPO. They pay premium rates for medical convenience, but keep their life insurance cheap so they can invest their remaining capital directly into the stock market. Finally, the wealth and tax strategist. These are high earners who have maxed out traditional retirement accounts and urgently need new tax-sheltered growth vehicles. This calls for the optimizer stack, an indexed or variable universal life policy paired with a PPO. This tier provides permanent legacy protection and tax-free liquidity, but it also creates a second job monitoring sub-accounts to prevent a total policy lapse. The ultimate optimization is ruthlessly matching your current capital and your willingness to manage complexity to the exact right stack. Choosing the wrong tier will either bankrupt you today or severely restrict your options tomorrow.